Are you satisfied with the taxes you pay? Are you confident you're taking advantage of every available break? Is your tax advisor giving you proactive advice to save on taxes? I've got bad news and I've got good news. The bad news is you're right. You do pay too much tax, and you're probably not taking advantage of every tax break you can. And most advisors do a poor job of actually saving their clients money. The good news is you don't have to feel this way. You just need a better plan. Today we're going to talk about some of the biggest mistakes that business owners make. Then we'll talk about how to solve them. Hello, my name is Dolores Sheets, and I started Dolores Sheets Accounting and Tax to give clients like you a different kind of service. I don't just record the history you give me, I go beyond to give you proactive advice and strategies to help you earn more and keep more. The first mistake is the biggest mistake of all, and that's failing to plan. I don't care how good you and your tax preparer are with a stack of receipts on April 15th. If you didn't know you could write off your kids' braces as a business expense, there's nothing we can do. Tax coaching is about giving you a plan for minimizing your taxes. What should you do? When should you do it? And how should you do it? And tax planning gives you two more powerful advantages. First, it's the key to your financial defenses. As a business owner, you have two ways to put cash in your pocket. Financial offense is making more. Financial defense is spending less. For most of us in this room, taxes are our biggest expense, so it makes sense to focus our financial defense where we spend the most. Sure, you can save 15% on car insurance by switching to Geico. Everybody knows that. But how much will that really save you in the long run? And second, tax planning guarantees results. You can spend all sorts of time, effort, and money promoting your business, but that can't guarantee results. Or you can set up a medical expense reimbursement plan, deduct your daughter's braces, and guarantee the savings. Now let's start by taking a quick look at how the tax system works. This will lay a foundation for understanding the specific strategies we'll be talking about soon. The process starts with income, and this includes most of what you think the IRS is interested in. Earned income from wages, salaries, bonus, and commissions, profits and losses from your own business. Interest and dividends from bank accounts, stocks, bonds, and mutual funds, capital gains from property sales, pensions, IRAs, and annuity income, alimony, and gambling winnings. Even illegal income is taxable. The IRS doesn't care how you make it, they just want their share. And the good news is, if you're operating an illegal business, you can still deduct the same expenses as if you're running a legitimate business. If you're a bookie, you can deduct the cost of a cell phone you use to take the bets. Once you've added up your total income, it's time to start subtracting adjustments to income. These are a group of special deductions listed on the first page of Form 1040 that you can take whether you itemize deductions or not. Total income minus adjustments to income equals adjusted gross income, or AGI. Adjustments to income are also called above the line deductions because you take them above AGI. Adjustments include IRA contributions, moving expense, half of your self-employment tax, self-employed health insurance, self-employed retirement plan contributions, alimony you pay, and student loan interest. Once you've determined adjusted gross income, you can take a standard deduction or itemized deductions, whichever is greater. The standard deduction for 2015 is $6,300 for single taxpayers and $9,250 for heads of household. It's $12,600 for joint filers and $6,300 each for married couples who file separately. Tax deductions reduce your taxable income. If you're in the 15% bracket, an extra dollar of deductions cuts your tax by 15 cents. And if you're in the 35% bracket, that same extra dollar of deductions cuts your tax by 35 cents. You can also deduct a personal exemption of $3,950 for yourself, your spouse, and any dependents. Once you've subtracted deductions and personal exemptions, you'll have taxable income. At that point, the table of tax brackets tells you how much to pay. You may also owe self-employment tax, which replaces Social Security and Medicare for sole proprietors, partnerships, and LLCs. You'll also owe state and local income and earnings taxes. Some types of income aren't taxed at the regular rate. For example, Tax on qualified corporate dividends and long-term capital gains is capped at 20%. There's also a 3.8% unearned income Medicare contribution on investment income for single taxpayers earning more than $200,000 and joint filers who earn more than $250,000. For purposes of this new rule, investment income includes interest, dividends, capital gains, rental income, royalties, and annuity distributions. Oh, and don't forget that your itemized deductions and personal exemptions start phasing out once your income hits certain levels. For 2014, those are $254,200 for singles, and for joint filers, it's $305,050. The bottom line here is that tax brackets aren't as simple as they might appear. Your actual tax rate can be quite a bit higher than your supposed tax bracket. Finally, you'll subtract any tax credits. These are dollar for dollar tax reductions, regardless of your tax bracket. So if you're in the 15% bracket, a dollar's worth of tax credit cuts your tax by a full dollar. And if you're in the 35% bracket, an extra dollar's worth of tax credits cut your tax by that same dollar. There's no secret to tax credits other than knowing what's out there. Ultimately, there are two kinds of dollars in this world: pre-tax dollars and after-tax dollars. Pre-tax dollars are great, and after-tax dollars aren't bad, but they're not as good as pre-tax dollars. So here's the bottom line. You lose every time you spend after-tax dollars that could have been pre-tax dollars. Let me repeat that. You lose every time you spend after-tax dollars that could have been pre-tax dollars. We're going to spend the rest of this presentation talking about how to turn after-tax dollars into pre-tax dollars. We're going to use three primary strategies. First, earn as much non-taxable income as possible. Second, make the most of adjustments to income, deductions, and credits. That's really no magic to it other than knowing what's available. And finally, shift income to later tax years and lower bracket taxpayers. This includes making the most of tax-deferred retirement plans and shifting income to lower bracket children, grandchildren, and other family members. The second mistake is nearly as important as the first, and that's fearing rather than respecting the IRS. What does the kind of tax planning we're talking about do to your odds of being audited? The truth is, most experts say it pays to be aggressive. That's because overall audit odds are so low that most legitimate deductions aren't likely to wave red flags. Audit rates are actually at historic lows. For 2014, the overall audit rate was just 1 in every 100 returns. The IRS primarily targets small businesses, especially sole proprietorships, and cash industries like pizza parlors and coin-operated laundromats that have opportunities to hide income and skim profits. In fact, they do publish a series of audit guidelines that you can download from their website that tell you exactly what they're looking for when they audit you. Take a look at the bottom of the chart. You'll see that the IRS audits just 0.5% of S corporations and partnerships. If you're really worried about being audited, you might consider reorganizing your business to help fly under the radar. The next mistake is choosing the wrong business entity. Most business owners start as sole proprietors, then as they grow, they establish a limited liability company or a corporation to help protect them from the business liability. But choosing the right business entity involves all sorts of tax considerations as well. And many business owners are operating with entities that may have been appropriate when they were established, but they just don't work as efficiently now. I can't make you an expert on business entities, but I do want to walk through one popular choice to illustrate how important this question can be. If you operate your business as a sole proprietorship or a single member LLC, taxed as a sole proprietorship, you may pay as much in self-employment tax as you do in income tax. If that's the case, you might consider setting up an S corporation to reduce that tax. If you're taxed as a sole proprietor, you'll report your net income on Schedule C. You'll pay tax at whatever your personal rate is, but you'll also pay self-employment tax of 15.3% on your first $108,500 of net self-employment income and 2.9% of anything above that. And now you'll pay a new 0.09% surtax on any earned income over $200,000 if you're single and $250,000 if you're married filing jointly, or $125,000 if you're married filing separately. Let's say your profit at the end of the year is $80,000. You'll pay regular tax at your regular rate, whatever that is. Then you'll also pay about $11,000 in self-employment tax. The self-employment tax replaces the Social Security and Medicare tax that your employer would pay and withhold if you weren't self-employed. Now, how many of you plan to retire on Social Security? An S corporation is a special corporation that's taxed like a partnership. The corporation pays you a reasonable wage for the work you do. If there's any profit left over, it passes through to you, and you pay the tax on that income on your own return. So the S corporation splits the owner's income into two parts, wages and pass-through distributions. Here's why the S corporation is so attractive. You'll pay the same 15.3% tax on your wages as you would on your self-employment income, but there's no Social Security or self-employment tax due on the dividend pass-through. Let's say your S corporation earns the same $80,000 as your proprietorship. If you pay yourself $40,000 in wages, you'll pay about $6,120 in Social Security, but you'll avoid the employment tax on the income distribution, and that saves you $5,184 in employment tax that you would have paid without the S corporation. Now let's talk about the fourth mistake, choosing the wrong retirement plan. If you're looking to save more than the $5,500 limit for IRAs, you have three main choices: simplified employee pensions or SEPs, simple IRAs, or 401ks. I'm not here to make you an expert on retirement plans, but I can help you decide pretty quickly if the plan you have is right for you or if you should be looking for something more suited for your specific needs. So bear with me. Even if the next few slides look intimidating, these are some very powerful strategies. The SEP is the easiest plan to set up because it's just a turbocharged IRA. If you're self-employed, you can contribute up to 25% of your net self-employment income. If your business is incorporated and you're salaried, you can contribute 25% of your covered compensation, which is roughly the same as your salary. The maximum contribution for 2015 is $53,000. If you've got employees, you'll have to contribute for them too. You generally have to contribute the same percentage for your employees as you do for yourself. However, you can use what's called the integrated formula to make extra dollar contributions for higher incomes. The money goes straight into an employee IRA account. There's no annual administration or paperwork required. The SEP is easy to adopt, easy to maintain, and very flexible. If there's no money to contribute, you just don't contribute. But the contribution is limited to a percentage of your income. So if you set up an S corporation to limit self-employment tax, you'll also limit your SEP contribution. The next step up the retirement plan ladder is the simple IRA. This is another turbocharged IRA that lets you contribute more than the usual $5,500 limit. You and your employees can contribute up to $12,500. If you're 50 or older, you can make an extra $3,000 catch-up contribution. If your income is under $50,000, that may be more than you could sock away with a SEP, and that's because $12,500 is more than 25% of whatever you can contribute to the SEP. But you do have to match everyone's deferral or make profit-sharing contributions. You can match everyone's contribution dollar for dollar up to 3% of their pay, or contribute 2% of everyone's pay whether they defer or not. If you choose the match, you can reduce it as low as 1% for 2 years out of 5. The money goes straight into employee IRAs. You can designate a single financial institution to hold the money, or let your employers choose. Like the SEP, there's no setup charge or annual distribution fee. The simple IRA may be best for part-time or sideline businesses earning less than $50,000. You can also hire your spouse or children, and they can make simple contributions. We'll be talking more about those strategies in a few minutes. The final step up the ladder is the 401k. Most people think of 401ks as retirement plans for bigger businesses, but you can set up what's called a solo or individual 401k just for yourself. The 401k is a true qualified plan. This means you'll set up a trust, adopt a written plan agreement, and choose a trustee. But the 401k lets you contribute far more money, far more flexibility than either the SEP or the simple. You and your employees can defer 100% of your income up to $18,000. And if you're 50 or older, you can make an extra $60,000 catch-up contribution. You can choose to match your employees' contribution or make profit-sharing contributions up to 25% of their pay. That's the same percentage you could save in your SEP on top of the $18,000 deferral. The maximum contribution for 2015 is $53,000 per person, plus any catch-up contributions. You can offer yourself and your employees loans, hardship withdrawals, and all the bells and whistles the big boys offer their employees. 401ks are generally more difficult to administer. There are anti-discrimination rules to keep you from stuffing your own account while you stiff your employees. And if you operate your business by yourself, you can establish an individual 401k with less red tape. And again, you can hire your spouse and contribute to their account. If you're older and you want to contribute more than the $53,000 limit for a SEP or a 401k, consider a traditional defined benefit pension plan. Defined benefit plans let you guarantee up to $210,000 in annual income. You can contribute and deduct as much as you need to finance the benefit. You'll calculate those contributions according to your age, your desired retirement age, your current income, and various actual factors. A 412I plan, which is funded entirely with life insurance or annuities, lets you contribute even more. Defined benefit plans have required annual contributions, but you can combine a defined benefit plan with a 401k or SEP to give yourself a little bit more flexibility. Now let's talk about the fifth mistake, missing family employment. Hiring your children and grandchildren can be a great way to cut taxes on your income by shifting it to someone who pays less. And yes, there is a minimum wage. They have to be at least 7 years old. Their first $6,300 of earned income is taxed at zero, and that's because it's a standard deduction for a single taxpayer, even if you claim them as your dependent. Their next $9,225 is taxed at just 10%, so you can shift a lot of income downstream. You do have to pay them a reasonable wage for the service they perform. The tax court says a reasonable wage is what you'd pay a commercial vendor for the same service, with an adjustment made for the child's age and experience. So, if your 12-year-old son cuts your grass for your rental properties, pay him what a landscaping service might charge you. If your 15-year-old helps keep your books, pay him just a little bit less than a bookkeeping service might charge. Does anyone have a teenager that helps you with your website? What would you pay a commercial designer for that service? To audit-proof your return, write out a job description and keep a timesheet. Pay by check so you can document the payment. You do have to deposit the check into an account in your child's name, but this doesn't have to be his pizza and Nintendo fund. It can be a Roth IRA for decades of tax-free growth. It can be a Section 529 college savings plan, or it can be a custodial account that you control until they turn 21. Now, you can't use the money in a custodial account for your obligations of parental support, but private schools aren't obligations of parental support, and sleepaway summer camp isn't an obligation of parental support either. Let's say your teenage daughter wants to spend 2 weeks at horse camp. You can earn the fee yourself, pay tax on it, and pay for the camp with after-tax dollars. Or you can pay her to work in your business, deposit the check in her custodial account, and then as custodian, stroke the check to the camp. Hiring your daughter effectively lets you deduct her camp as a business expense. If you hire your child to work in an unincorporated business, you don't have to withhold for Social Security until they turn 18. So this really is tax-free money. You'll have to issue them a W-2 at the end of the year, but this is painless compared to the tax you'll waste if you don't take advantage of this strategy. Now let's talk about health care cost. Surveys used to show that taxes used to be a small business owner's biggest concern, but now it's the rising health care cost. If you pay for your own health insurance, you can deduct it as an adjustment to income on page 1 of Form 1040. If you itemize deductions, you can deduct unreimbursed medical and dental expenses on Schedule A if they total more than 10% of your adjusted gross income, but most of us don't spend that much. What if there was a way to write off medical bills as business expenses? There is, and it's called a medical expense reimbursement plan or a Section 105 plan. The Section 105 plan is an employee benefit plan. That means somebody needs to qualify as an employee. The problem is, if you run your business as a sole proprietorship, which includes a single member LLC, a partnership, or an S corporation, you're considered self-employed, and you can't get the benefits from the plan. So you'll have to figure out another way to qualify. If you're a sole proprietor or a single member LLC taxed as a proprietorship and you're married, you can hire your spouse. If you're a partner in a partnership or LLC taxed as a partnership, you can hire your spouse as long as they don't own more than 5% of your company. If you're a shareholder or a member of an entity taxed as an S corporation, you don't qualify and your spouse doesn't qualify either. Your best bet in that situation is to segregate part of your income into a separate entity, such as a proprietorship or a C corporation, and run the plan through that entity. Finally, if you run your business or even a part of your overall business as an entity taxed as a C corporation, you do qualify as an employee all by yourself. By the way, you can also use the 401 plan for family members other than your spouse. Let's say you're a single mom working as a real estate agent. You can hire your teenage child and use the plan to pay for their eyeglasses, braces, or other medical costs. You can even hire a retired parent to help cover their medical costs. The plan has to cover all eligible employees. You can't just cover yourself or your family and exclude everyone else. However, there are several safe harbors you can use to limit coverage. Specifically, you can exclude employees under age 25, employees working for you less than 35 hours per week, employees working less than 9 months per year, and employees who have worked for you for less than 3 years. There are a couple of other exclusions for larger employees, and the IRS doesn't pay a whole lot of attention in this area, but the fact remains that you do have to cover all employees. So if you have non-family employees and can exclude them under one of these rules, the 105 plan may not be appropriate for you. Now for the benefit. Once you qualify, the plan lets you reimburse your employee for all medical expenses they incur for themselves, their spouse, and their dependents. Let's say you're a married sole proprietor and you hire your spouse. You can reimburse them for all medical expenses they incur for themselves, their spouse, which would be you, and your dependents. Now you've taken what probably would have been a non-deductible personal expense and converted it into a business expense. You'll avoid the 10% floor on itemized deductions, and you'll pay and if you pay self-employment tax on your net income, you'll even avoid paying self-employment tax on the money you deduct through the 105 plan. That's another 15.3% or 2.9% or 3.8% depending on your self-employment income. Now, what exactly can you deduct? Well, pretty much everything you can think of. This includes all the expenses you see listed here: major medical insurance, long-term care coverage, Medicare Part B and D coverage, Medigap insurance, co-pays, deductibles, and prescriptions, dental, vision, and chiropractic care, big ticket items like braces for your kids' teeth, LASIK surgery for your eyes, fertility treatments, and special schools for learning disabled children. You can even reimburse for over-the-counter medications, vitamins, and herbal supplements, and medical supplies, as long as they are actually prescribed by a physician. The best part is, this is money you'd spend anyway, whether you get to deduct it or not. You're just moving it from a non-deductible place in your return to a deductible place. You'll need a written plan document, which we can provide for you. You'll need to make sure the benefits you pay are reasonably compensation for the work your employer does. If your teenager stuffs a few envelopes for you, the IRS will have a hard time believing a full set of braces is reasonable compensation for that little bit of work. You'll need to verify the work your employee does in order to establish that the benefits you pay are reasonable compensation. This is a big hot button with the IRS and the tax court. Finally, you'll need to establish a paper trail to verify payment. This means tracking expenses, of course. It also means reimbursing your employee out of the business or paying their expenses directly out of the business. It's not enough just to pay your family's expenses out of your personal funds. Total them up and deduct them at the end of the year. A couple of recent tax court cases have established that you really do need to establish a business link to these expenses. There's no need for an outside third-party administrator. However, IRS rules state that employees can't self-certify their own expenses. There's no special reporting requirement. You'll report reimbursements as employee benefits on Schedule C, Form 1065, or Form 1120. You'll save income tax and self-employment tax. There's no pre-funding required. You don't have to open a special account like with the health savings account or flex spending account. You don't have to decide ahead of time how much to contribute, and there's no use it or lose it rule. This plan really is just an accounting device that lets you characterize your family medical bills as business expenses. All Section 105 plan sponsors must file Form 720 to report and pay Patient-Centered Outcomes Research Institute fees of $2 per participant by July 31st of the year following the plan year. Ordinarily, this form is filed quarterly. However, if an employer owes no other excise tax, they may file it annually. If a medical expense reimbursement plan isn't appropriate, consider the new health savings account. These arrangements can combine a high deductible health plan with a tax-free savings account to cover unreimbursed costs. To qualify, you will need a high deductible health plan with a deductible of at least $1,300 for single coverage or $2,600 for family coverage. Neither you nor your spouse can be covered by a non-high deductible health plan or Medicare. The plan can't provide any benefit other than certain preventative care benefits until the deductible for that year is satisfied. You're not eligible if you're covered by a separate plan or rider offering prescription drug benefits before the minimal annual deduction is satisfied. Once you've established your eligibility, you can open a deductible savings account. You can contribute up to $3,350 for singles or $6,650 for families. You can use it for most kinds of health insurance, including COBRA continuation and long-term care premiums. You can also use it for the same sort of expenses as a Section 105 plan. The health savings account isn't as powerful as a Section 105 plan. You've got specific dollar contribution limits and there's no self-employment tax advantage, but health savings accounts can still cut your overall health care cost. The home office deduction is probably the most misunderstood deduction in the entire tax code. For years, taxpayers feared it raised an automatic audit flag, but Congress has relaxed the rules, so now it's far less likely to attract attention. First, let's talk about how you qualify for the home office deduction in the first place. Your home office qualifies as your principal place of business if 1. You use it exclusively and regularly for administrative or management activities of your trade or business, and 2. You have no other fixed location where you conduct substantial administrative or management activities of your trade or business. This is true even if you have another office, as long as you don't use it more than occasionally for administrative or management activities. You have to use your office regularly and exclusively for business. Regularly generally means 10 to 12 hours per week. To prove your deduction, keep a log and take some photos to record your business use. You can claim a workshop, studio, or separate identifiable space that you use to store products or samples. The space doesn't have to be an entire room. And if you use it for more than one business, both have to qualify to take the deduction. Once you've qualified, you can start deducting business expenses. If your tax as a proprietor, you'll use Form 8829, and if your tax is a partnership or corporation, there's no separate form which helps you fly under the radar. First, you'll need to determine business use percentage of your home. You can divide by the number of rooms if they roughly equal or calculate the exact percentage of your square footage. You can exclude common areas like hallways and stairs to boost your family use percentage. Next, you'll deduct your business use percentage of rent, mortgage interest, and property taxes. You'll depreciate the business use percentage of your home's basis, excluding land, over 39 years as non-residential property. Finally, you'll deduct your business use percentage of utilities, repairs, insurance, garbage pickup, and security. If your business use percentage for specific expenses differ from business use percentage for your overall home, such as high electric bills for home office equipment, you can claim the difference as direct expenses. Claiming a home office can also boost your car and truck deductions. That's because it eliminates non-deductible commuting miles for that business. You can use home office expenses to shelter profits, but not below zero. If your home office expenses exceed your net business income, you can carry forward those excess losses to future years. When you sell your home, you'll have to recapture any depreciation you claim or could have claimed after May 6, 1997. You can still claim the $500,000 tax-free exclusion for home office space unless it is a separate dwelling unit. If all this seems like too much work, there's a new safe harbor method that lets you claim $5 per square foot for up to 300 square feet of qualifying home office. However, using a safe harbor method might not let you claim nearly as much as a traditional method. We can help you walk through the calculations to see which method would be best for you. Now let's talk about car and truck expenses. I don't want to take too much time here, but I do want to point out some of the most common mistakes clients make with these expenses. You'll see that the standard deduction is 57.5 cents a mile. The deduction is the same for everyone, no matter what we drive. Do you think we all spend the same to operate our cars? It might surprise you to see how much it really does cost to operate your car, and it's not exactly 57.5 cents per mile. Every year, AAA publishes a vehicle operating cost survey. Costs vary according to how much you drive, but if you're taking the standard deduction for a car that costs more than 57.5 cents a mile, You're losing money every time you turn that key. If you're taking a standard deduction now, you can switch to the actual expense method if you own your car, but not if you lease it. And you can't switch from actual expenses to the mileage allowance if you've taken the accelerated depreciation. Now let's finish up with some fun deductions for meals and entertainment. The basic rule is that you can deduct costs for meals with a bona fide business purpose. This means clients, prospects, referral sources, and business colleagues. Now let me ask you, when do you ever eat with someone who's not a client, a prospect, referral source, or business colleague? If you're in a business like real estate, insurance, or investments, where you're marketing yourself, that answer might be never. Be as aggressive as you can with what you define as bona fide business discussion. The general rule is you can deduct 50% of your meals and entertainment, as long as it isn't lavish or extraordinary. The IRS knows you have to eat, so you can't deduct it all, but they'll meet you halfway. How many of you entertain at home? Do you ever discuss business? Are you deducting those meals too? There is no requirement that you have to eat out, so don't forget to deduct home entertainment expenses too. You can deduct entertainment expenses if they take place directly before or after substantial bona fide discussion that is directly related to your active conduct of your business. You can deduct the face value of tickets to sporting and theatrical events, food and beverages, parking, taxes, and tips. You don't need receipts for expenses under $75, but you do need to record the 5 pieces of information you see listed on the right side of the screen in your business diary or records, and you should do it as close to daily as possible. The IRS wants to know the cost of the meal, the date of the meal, the place where it takes place, the business purpose of your discussion, and your business relationship with your guest. Now that you see how business owners miss out on tax breaks, let's talk about the biggest mistake of all. What mistake is that? The biggest mistake of all is failing to plan. Have you ever heard the saying, if you fail to plan, you plan to fail? It's a cliche because it's true. Fortunately, our tax coaching service avoids the problem. We offer true tax planning. We tell you what to do, when to do it, and how to do it. We start with a 3-page check-the-box questionnaire that takes 5 minutes to fill out. Then we'll prepare a written tax plan that addresses your family, home, and job, your businesses, and your expenses and your investments. We'll even review your last 3 tax returns to see if we can find savings that you have overlooked. If you're serious about the strategies we've discussed today, why not give it a try? I will find the mistakes and missed opportunities that may be costing you thousands of dollars per year. Now that you've seen how we can tackle your tax challenges, take the next step and call today. Dolores Sheets, 970-739-9154, and visit us on the website, www.sheetstaxes.com. Thank you for investing your time in my slide today, and have a great day.